From Bloomberg World Headquarters in New York, this is Street Smart with Carol Massar and Matt Miller.
Welcome back to Street Smart. I'm Carol Massar. I'm here at the M&A Advisors Annual Distressed Investing Summit, and I'm joined by our next guest. He's Peter Kaufman. Peter, by the way, is the president of the Gordian Group. It is one of the nation's leading independent investment banks specializing in advising not only troubled companies, but also troubled governments. And Peter, there are a lot of troubled governments around the world. How would you assess the state of our states, the state of our municipalities right now?
Well, there's clearly budget gaps. There's a huge mismatch between the tax revenues that have come in and the need for cash outflows for social services and the like. And there are huge budget gaps at every level, municipal, state, they're huge numbers. Is
it as bad as Meredith Whitney says? She says basically, you know, we're on the verge of a muni market apocalypse. I mean, is that how you would assess it?
No, I wouldn't. I do believe that we are going to see restructurings of municipalities, potentially states, but definitely municipalities around the country, which should include, in my view, asking everybody around the table to take some pain, including the bondholders. I do not think there's going to be a collapse in the municipal bond market, but I do believe that for the first time we may see compromises of bondholders.
To get things done. Let me ask you though, if Meredith Whitney was here, she would probably say, I'm guessing, I've done a lot of research, I've looked at this, and here's what I'm saying. What have you seen that says it's not going to be as bad as she expects?
Well, I don't think that there's going to be a tsunami. I do think that there will be municipalities who are going to have a lack of political will to raise taxes, right? Because if they're raising taxes, they probably, although not necessarily, won't need to do a financial restructuring. But what you're seeing in Wisconsin is a huge example of this, a big focus on taking it out of the hides of the public unions. I think that's wrong. In classic restructurings in the corporate world, a hallmark, except when we're advising, is an equitable sharing of the pain of all of the constituencies. We like to have our clients do better than everybody else. But here, with what Wisconsin's trying to do, just by way of example, there's no equitable sharing of the pain. The bondholders, who are also unsecured creditors, just like union pensions and collective bargaining agreements, they're not being asked to share any of the pain. And I think that you're going to see municipalities, and all you need is one or two to step up to the plate and say, we're going to ask everybody to share some pain, including our bondholders. And then I think that the stigma will lessen, and you'll see more and more of them do it. But I don't think you're going to see a collapse in the market.
Any idea on where you think that we'll see this? Obviously, we're talking about Wisconsin, but what about other areas around the country? Is it the usual suspects? Is it somewhere in California? Is it somewhere? I mean, give us an idea of where you think geographically we might see this play out.
Yeah, those are the usual suspects. But you know, Michigan, for example, has a lot of cities that are in big trouble. And remember, for a municipality to be able to file Chapter 9, which is the municipal equivalent of bankruptcy, they're only allowed to do it in half of the states of the union, and the other half of the states they need to get permission.
Right.
You know, that narrows down the scope. I don't believe you're necessarily going to see a slew of Chapter 9 filings, but if a municipality has the political will to say, listen, here's what I'm going to be able to do to everybody if we go into Chapter 9, why don't we all come to the table, solve our problems outside of it? That's what I think you might see a lot of.
Are you already, I know you probably can't reveal a lot of details and stuff, but are you already talking with various municipalities about potentially doing this?
And unions, yes.
You are?
Yes.
So you're seeing that, and are you seeing a pickup in that kind of activity and interest?
Well, everyone's concerned, and you know, the unions have a big bullseye on them, and they need to be well armed and prepared, because right now they're getting the short straw. We think that's wrong, and we think that there needs to be an equitable sharing of the pain at Gordian Group.
But bottom line, you think it's manageable?
I do. I don't think the sky will fall if holders of municipal bonds are asked to take a haircut and compromise.
Let me also ask you, because we've talked a lot about the environment here, and you know, a lot of people are emphasizing some of the good economic news that's out there. Do you buy it?
No.
You don't buy it?
No. There are two economies in this country. There's the luxury high-end markets. Bulgaria was just acquired for $6 billion. Luxury
doing just fine.
It's doing great. The rest of the economy, companies are showing, by and large, as we've learned at this conference specifically, EBITDA, cash flow is going up, but that's primarily because even if the ones that are serving the lower to middle market to the lower middle market, because they're able to cut costs, they're taking it out of pension costs of workers, they're laying workers off. There's a finite amount of that these companies can do before they're going to run smack into the reality that there are 25 million Americans under or unemployed, and the two economies are not all well.
When that day comes, I mean, how do you think it plays out? How tough is it in terms of for those companies that are in a tough state but have been able to kick the can down the road by either tapping into the high yield market, getting some financing? I mean, how do you think it'll play out?
Well, this will end in a couple of ways. Either they're going to have their markets not be able to serve their companies because people are unemployed and the middle market, the lower middle market is not very healthy, and or you're going to see interest rates rise, and I think you're already starting to see that. Commodity prices rising, we're starting to see that. There are an awful lot of businesses that cannot pass along to the consumer the commodity price increases in their inputs, and so that's going to be a stumble. Exogenous events like what's going on in Libya is going to affect this. So I think when you see inflation start to come back, when LIBOR becomes a real number and not 0%, that's when I think you're going to see things start to, you're going to see some action in the restructuring space.
You know, we've been covering so much about what's going on in distressed investing. I think in the midst of the crisis, everybody got it, whether it was GM, whether it was Lehman, whether it was AIG, in terms of how much we focused on that market. I'm thinking for a lot of viewers who are watching this saying, why is it so important for me to understand what's going on when it comes to the world of distressed investing? Why is it so important?
Well, because it's going to ripple through and have an impact on everything. For example, banks have been, the last couple of years, pretty loath to foreclose on middle to upper middle market companies because they don't want to have to take the hit for what happens when they do that. As and when banks start to feel healthier about their own balance sheets, they're going to be a lot less sanguine about saying, let's kick the can down the road, let's just let you keep on going. So banks will get a little bit more aggressive with borrowers, and that in turn ripples through everything.
All right, so obviously something to keep a watch on. Any areas in particular that you've been watching in distressed investing? We've talked about retail at this summit. They talked about media. How about you specifically?
Anything, any businesses, any sectors, restaurants, for example, where commodity prices impact what they do, because, as I say, commodity prices are rising and companies will not be able to pass along those costs to the consumers. I'd be watching those.
So they're going to fill the space. Peter, thank you so much. We appreciate it.
Thanks for having me.
Peter Kaufman, everybody.